Hello, my name is Hayden Sorbo, and I'm doing Case A on the Financial Management and Securities of Risk and Return. Our first question of the day is, why is the T-bond return shown to be independent of the state of the economy? The T-bill return does not depend on the state of the economy because the Treasury must redeem the bill regardless of the state of the economy. Is the return on a one-year T-bond risk-free? The answer is yes. The return on a T-bond is risk-free because it is nearly free of default risk because it is fully backed by the U.S. government. Here we calculate the expected return of the four alternatives. We have the T-bond rate, Entergy Corporation, Freeport, and the S&P 500. Here, our expected return for a T-bond is 3%, for Entergy is 7.5%, Freeport 5.9%, and for the S&P 500, 9%. And the S&P 500 in this example is the best investment. Here, we calculate the standard deviation and coefficient of variation. The standard deviation measures the risk of the investment. The coefficient of variation measures the risk and the risk on the expected return. So, in this example, the coefficient of variation is more useful because it measures the risk while also measuring the risk on the expected return. So for here, we ran an analysis and we got a standard deviation and coefficient of variation for 0 on the T-bond rate. For Entergy, we got a standard deviation of 6.4 and a coefficient of variation of 0.85. For Freeport Corporation, we had a standard deviation of 5.5 with a coefficient of variation of 0.9. And for the S&P 500, we had a standard deviation of 9.8 and a coefficient of variation of 1.0. And it is keen to have a lower standard deviation and a lower coefficient of variation because that indicates less risk. For this question, we are supposing that an investor invests $10,000 in a stock portfolio in Freeport and $10,000 in Entergy. So for here, they both have a weight of 0.5 and the expected portfolio return of Entergy is 7.5 with a 5.9 expected return for Freeport. And that gave us an expected portfolio return of 6.7. And so for here, for the portfolio of $10,000 for each company, we got a standard deviation of 1.7 and a coefficient of variation of 0.25, which is fairly low. For portfolio 1, the weight of Entergy being 25%, the weight of Freeport being 25%, 75%, we got an expected return of 6.3 and a standard deviation of 2.9 with a coefficient of variation of 0.4, which is a little bit higher. And for the second portfolio, Entergy was 75% of the portfolio and Freeport was 25% of the portfolio. And in this scenario, the expected return was 7.1, which is still a little higher, standard deviation of 3.7, and a coefficient of variation of 0.5. As you can see here, the expected rate of return increased as well with the standard deviation and the coefficient of variation. And with the first problem, the coefficient of variation and the standard deviation are both lower. For this portfolio, we have the Entergy Corporation and the S&P 500, both with $10,000 weights. And so, in this portfolio, we have expected returns of 7.5 for Entergy and 9.0 for the S&P 500, coming to an expected portfolio weight of 8.25. And so for this portfolio, we had a standard deviation, came out to 8.1, and a coefficient of variation of 0.9. And the question was, would this portfolio have the same risk-reducing effect as the last? And that would be no, because the standard deviation and coefficient of variation are both higher, meaning that this is a riskier portfolio. What would happen to the portfolio's risk if more and more stocks were added? The risk of the portfolio would decrease because having a more diversified portfolio helps risk, because having stocks in different industries will help neutralize the amount of risk, because if you hold a centralized portfolio of one industry, it could negatively affect your portfolio. Total risk is comprised of the unsystematic and systematic risk of any given investment. Diversifiable risk is the type of uncertainty that comes with the company or industry that you choose to invest in. And market risk is the possibility of an investor experiencing losses due to factors in the overall stock market. Assume you choose to hold a single stock portfolio. Should you expect to be compensated for all risk that you bear? The answer is no, because you are not given any reward for investing in a single stock unless the stock yields dividends. So as you can see here, we ran a regression of the S&P 500 versus Freeport, Entergy, and the T-bond rate. And these lines here are called the market security lines, and they represent the beta or the risk. And so our independent variable, which was X, was the S&P 500 in this case, and the Y variable in this case was the T-bond rate, Entergy, and Freeport. And each one of these has a direct impact on a change on the S&P 500. So if the S&P 500 were to increase or decrease, it will positively or negatively directly affect one of those investments. And the significance between the distance between the trend line and regression helps determine whether the stock is properly valued or overvalued. For this problem, we plotted the security market line. Entergy Corporation's beta is 0.6, and we found a required rate of return of 6.60. Then we regressed the required return in beta and plotted that on a scatter plot to get a beta of 0.1178. Should investors buy Entergy Corporation? Yes, because the required rate of return is 6.60 and the expected rate of return exceeds that at 7.5%. But if the market risk premium and the beta were to rise, that would require an expected rate of return of 10%, which would then exceed the expected rate of return, and then it would not be a smart investment. If Entergy Corporation's required rate of return were to inflate by 3%, their new required rate would be 7.8%, which is an increase of 0.8% from their old required rate of 6.60%. The efficient market hypothesis is an investment theory whereby share prices reflect all information and constant alpha generation is impossible. The impact the efficient market hypothesis has on investing in securities is that it is not possible for an investor to constantly beat the market with given information. The efficient market hypothesis does not apply real assets such as property, plant, and equipment. If James were to hire additional staff, he should be concerned about the efficient market hypothesis because adding additional staff could negatively affect the stock price of his company. If Entergy could minimize its long-term debt, the company risk would decrease. So, if their debt-to-asset ratio continues to decrease, this would lower its beta but increase the required rate of return because instead of debt financing, they rely heavily on equity financing. Overall, lowering long-term debt will decrease the beta and ultimately could possibly attract new investors. Thank you.